Thinking about buying a new car? It's exciting, but let's be real, most of us aren't paying for it all at once with a briefcase full of cash. That's where auto loans come in, and understanding them is your superpower to getting a great deal. So, buckle up, because today we're demystifying car financing from start to finish. I'll walk you through everything you need to know to drive off the lot with confidence, not confusion. First, what exactly is an auto loan? Simply put, it's a secured loan where you borrow money from a lender like a bank, credit union, or the dealership's financing company to buy a vehicle. The car itself acts as collateral, which means if you stop making payments, the lender can take it back. Most people use auto loans because cars are one of the biggest purchases we make right after a house. Instead of saving up for years to pay in full, a loan lets you spread that cost over a set period, typically ranging from 3 to 7 years, making it much more manageable for your monthly budget. This process is often called financing, and it's how millions of people get behind the wheel of their dream car every year. So, how does this all work in practice? Let's break down the 3 core components of any auto loan. First up is the down payment. This is the initial amount of money you pay upfront. The bigger your down payment, the less money you need to borrow. This smaller loan amount is called the principal. A larger down payment is always a good idea because it lowers your monthly payments and reduces the total interest you will pay over time. Next, we have the APR, or annual percentage rate. This is the interest rate you'll pay on the money you borrowed, plus any lender fees, expressed as a yearly percentage. Your APR is one of the most important numbers in your loan because it determines the total cost of borrowing the money. A lower APR means you pay less interest, saving you hundreds or even thousands of dollars. Finally, all of this gets bundled into your monthly payment. Each month, you'll pay a fixed amount that covers a portion of the principal and the interest accrued. Your goal is to find a monthly payment that comfortably fits your budget while keeping the APR and the total cost of the loan as low as possible. It's a balancing act, but one you can master. Now, you might be wondering, what determines my interest rate? Lenders don't just pick a number out of a hat. Several key factors influence the APR you're offered. The most significant one is your credit score. A higher credit score signals to lenders that you are a reliable borrower, so they'll reward you with a lower interest rate. A lower score suggests more risk, which usually means a higher APR. The loan term, or the length of your loan, also plays a huge role. Shorter terms, like 36 or 48 months, often come with lower interest rates. Longer terms, like 72 or even 84 months, might have slightly higher rates because the lender's money is tied up for a longer period, increasing their risk. The vehicle itself matters too. Lenders generally offer better rates for new cars compared to used ones. Why? Because a new car has a more predictable value and is less likely to have mechanical issues. An older, high-mileage used car is seen as a bigger risk. And remember that down payment we talked about? Putting more money down not only reduces your loan amount but can also help you secure a better interest rate because you are borrowing less and have more equity in the car from day one. Choosing the right loan term is a critical decision that directly impacts your finances. Let's look at the trade-offs. A shorter term, say 36 or 48 months, means you'll have higher monthly payments, but the upside is huge. You will pay off the car faster and pay significantly less in total interest over the life of the loan. You build equity quicker, and you're free from that car payment sooner, freeing up your cash for other goals. On the other hand, a longer term, like 60, 72, or even 84 months, is tempting because it offers lower, more manageable monthly payments. This can make a more expensive car seem affordable, but here's the catch. You'll end up paying way more in interest over time. A longer term also increases the risk of becoming upside down or having negative equity. This happens when you owe more on the loan than the car is actually worth. Cars depreciate quickly, so if you need to sell or trade in the car early in a long-term loan, you might have to pay the lender just to get rid of it. The sweet spot is the shortest term you can comfortably afford. When you're at the dealership, the sticker price is just the beginning. There are several other costs you need to factor into your total budget. First, there are taxes, title, and registration fees, which vary by state but can add a significant amount to your final bill. Dealerships also charge their own fees, sometimes called doc fees or dealer prep fees, which cover the cost of their paperwork and getting the car ready for you. Always ask for a breakdown of these fees. Then come the add-ons. The finance manager will likely offer you things like an extended warranty, which covers repairs after the factory warranty expires, and gap insurance. Gap, or Guaranteed Asset Protection, is actually pretty useful. It covers the gap between what you owe on your loan and what the car is worth if it is totaled in an accident or stolen. While these can be valuable, you don't have to buy them from the dealership. You can often find better prices for warranties and gap insurance from your own bank, credit union, or insurance provider. Don't feel pressure to decide on the spot. Alright, let's turn you into a smart shopper. My number one tip is to get pre-approved for a loan before you even set foot in a dealership. Go to your own bank or a local credit union and see what loan amount and interest rate you qualify for. This does two amazing things. It tells you exactly how much car you can afford, and it gives you a powerful negotiation tool. When you walk into the dealership with a pre-approved loan offer in hand, you're not just a car buyer, you're a cash buyer. You can then ask the dealer's finance office, "Can you beat this rate?" This forces them to compete for your business and often results in a better deal. Don't just accept the first offer. Compare rates from multiple lenders, your bank, credit unions, and reputable online lenders. A small difference in APR can save you a lot of money. And when you're looking at offers, always focus on the total cost of the loan, not just the monthly payment. A dealership can easily lower your monthly payment by stretching the loan term to 84 months, but you'll end up paying thousands more in interest. Ask for the out-the-door price that includes all taxes and fees, and compare the total amount you'll pay over the full term for each loan option. Let's run through a quick example to see how this works. Imagine you're buying a $30,000 car. First, let's look at a 36-month or 3-year loan. Your monthly payment would be about $823. Over 3 years, you'd pay a total of $29,628 for the loan. Now, let's stretch that same loan to a 72-month or 6-year term. Your monthly payment drops significantly to about $449. Much easier on the budget, right? But hold on. Over 6 years, your total loan repayment would be $32,328. The total interest you paid is now $5,328. By extending the loan, you lowered your monthly payment by almost half, but you ended up paying over $2,700 more in interest. That's double the cost. This is why looking at the total cost is so important. Unfortunately, there are a few dealership tactics you need to watch out for. One is yo-yo financing. This is when a dealer lets you drive the car home thinking your loan is approved, only to call you back days later saying the financing fell through and you need to sign a new contract with a much higher interest rate. To avoid this, never leave the lot until all the financing paperwork is final and signed by both you and the lender. Another is packed payments, where the dealer inflates your monthly payment by sneaking in add-ons like warranties or insurance without clearly disclosing them. They might just tell you the final monthly number. Always ask for an itemized breakdown of your payment. And finally, watch out for hidden fees. Read every line of your contract before you sign it. Verify the APR, the loan amount, the term, and the total cost. If something doesn't match what you discussed, don't sign. It's your money, and you have the right to understand exactly where it's going. So, to wrap it all up, financing a car doesn't have to be intimidating. It's all about preparation and knowledge. The best auto loan is one that fits your budget and your financial timeline. To get the best deal, work on improving your credit score before you start shopping. Save up for the largest down payment you can comfortably afford, and most importantly, get pre-approved and shop around for the best interest rates. By understanding these key principles, you can take control of the process, avoid costly mistakes, and drive away in your new car with a deal you feel great about. Thanks so much for watching. I hope this guide helps you on your car buying journey. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more tips on making smart money moves. Let me know in the comments if you have any questions or your own car buying tips to share. See you next time.